Analyst at Assar Investments, Muktar Mohammed says the strength of half-year corporate earnings, especially banks and policy decisions of the Monetary Policy Committee of the Central Bank of Nigeria, will define Nigeria's equities market performance in the third quarter of this year. Joins me now for more on the highlights of market movement so far and the outlook for the third quarter of this year. Thank you so much for joining us on the show today, Mr. Mohammed. Really now we're looking at the strength of the corporate earnings. We saw the Q1 numbers and then we are waiting for Q2. That helps to give a much more holistic view. But how strong do you see the numbers coming through?
Well, normally when Q1 comes in, you begin to determine, it shows you, give you a picture of what to expect in Q2. And again, Q2 now is half year, give you a picture to what you expect naturally to year end. So we expect some strong Q2 numbers, especially from some equities that have not done very well for a while, especially in their Q2 report. And we could see that there's a recovery from Q1. So we expect that momentum to be sustained in Q2, especially the manufacturing sector. We talk about stocks like Cadbury. We talk about stocks like Unilever. They've done some impressive price movement because of their first quarter. We talk about stocks like MTN also. You could see those impressive first quarter, and then again, you see that in the price of MTN at the moment. That is largely driven by NSCC policy and also the decision that now you have to pay for your bank code directly to them, and then some of this debt will be paid to them also. That is what people are leaning towards. Nestle Nigeria, Nestle has also performed credibly well.
Strong numbers.
Very, very strong numbers, and you can see that in the price rally. Yeah, the other one is always a toast of what Nigerian investors always look for, the financial sector. But as it stands now, we have to watch the space, what's going to happen in that space, especially with the CBN no dividend policy, and most of these banks that are expected, those banks are expected to pay dividend. But again, just last week, we started hearing those corporate announcements of close period, and most of them are saying we're closing period to look at the second quarter.
How much of a concern is this for shareholders who are always looking out for their dividend payments?
It's a big concern, David. You could see that when that report came in, you saw how the market responded very negatively. Because the Nigerian banking sector seems to be the liquid driver of most Nigerian investors. And this is what they've been doing over the years. We're not talking about 10 years, we're talking about 25 years. Even when the global crisis was in 2008, no bank, almost all the banks were still even struggling, and they were still paying dividends, no matter how small it is. So Nigerian investors have been wired-proof in terms of this dividend coming. And you see, they introduced a strategy. Normally before, you just get those dividends at the year end, but they came up with this interim dividends then. Yeah, so that has really excited investors, because most investors see this interim dividend sometimes to also reinvest into the market. Those stocks sometimes also use it as a means of cushioning for festivity period. So it has been wired into the Nigerian investors to always look up for this dividend, especially from the banking sector.
But when we are still looking at movements we should expect for banking stocks now, we know the dividend payment freeze is still until the year 2028. So any celebration is just for this time being. In terms of movement going forward, how do you expect? What sort of volatile or erratic movements should we expect?
I don't think it's freezing, because again, the freezing to get to 2028 was based on some parameters, forbearance, and you see a lot of those banks that were affected have said that, look, we are going to ease it by this quarter. And again, they are also not thinking of only easing it; they're also saying that they will even pay dividends. And now, when you look at that again, when you look at the reports from the bank from the first quarter, and then you look at their year end, you realize that most of these banks have enough liquidity to pay off those debts in one way or the other. In terms of, so sometimes again, you look at their earning per shares. That also could be a drive towards them paying up. But again, it depends on if CBN is saying, look, you can't use your retail earnings to pay off this again. You remember, they've come up with like the recapitalization. A lot of banks really didn't need to recapitalize. They have to go into their retail earnings. So it all depends. But based on the memo and based on what the bankers, I think I don't see any of them stay until 2028. Maybe just a few. And don't forget, some of these banks have holding structures. And like they said, if the banking sector cannot pay, the holding structure can pay. But most Nigerians knows that the chunk of the dividend comes from the banking sector. So that could be a game. Yeah, that, like I say, that will determine the erratic nature. And a lot of investors will be waiting to look at those numbers half year and to really see whether they will pay dividend of whatever kind and that will do it. But if at the end of this half year, we see those numbers, they're able to pay dividend, maybe not even meeting up to what they expect, but they were able to pay. And then looking at that, oh, they have also exit this forbearance, paying off everything, that could be a game changer, because that means investors will be hoping for high expectation. Don't forget that some of these banks have to recapitalize. They need to excite investors. And one of the ways they excite investors is through the dividend payment.
And talking about market excitement at this moment now, one of the news that came out from the Afrexim Bank annual meetings was the announcement we also had from the president of Dangote Group, Aliko Dangote, talking about the expectation of listing Dangote Fertilizer later this year, and also looking at Dangote Refinery coming on board on the Nigerian exchange to be listed in 2026. How do you see this boosting the market cap?
It's huge, David. I mean, we're having a global player, because what we will see, Dangote has told us that Dangote Fertilizer will meet the demands of African fertilizer need. And not only that, like he said,
it says in 40 months, no more exports of, imports of fertilizer.
In all over Africa.
Yeah.
And also, he's also saying that when you're investing in Dangote Fertilizer, you're investing in a global player. And so that, for me, is going to be very huge. That's one first time we'll see a big economic player right in the middle of the stock market, right in the midst of the stock market. So that would be good. That would be big. And especially, we can't just wait for 2026. I think 2026 is going to really be huge for the market. Dangote will be coming in, the refinery will be coming in, and also by March 2026, the recapitalization of bank should have come to an end. That will really ticks the market.
Yeah. And lastly now, when we're also looking at expected moves by next month, that's just less than 24 hours away, but we should see the MPC also meet, and then rate cuts at the center of discussions at this moment. Now, within the realm of easing interest rates, how do you see that rubbing off on the equities market? And let's not also forget, we've seen quite the rejection in terms of demand at auctions as well, when we're looking at the fixed income market. How do you see this impacting our equities market near term when we're looking at risk appetite overall for the market?
I think what we'll see is risk appetite is still largely, people still think the fixed income space is still very good with the return. But again, we've seen, like it's right to say, we've seen rate comes down. And again, if there's any rate cut, then that will drive a lot of investors in the fixed income space into the equity market, because again, they will now be looking not only at dividend yield, they will also be looking at capital appreciation. Any decision for the CBN to cut rate will be positive to the equity market. And remember that we started seeing this lump side in the equity market after that, when the CBN policy, and then we saw a lot of the fixed income space paying, some of them paying as high as 18 to 19%, especially the treasury bill. So, but now we've seen those reduction, and also even the commercial papers, which is short-term instrument, we are beginning to see reduction in terms of the rates they give to investors. So definitely any cut in rate will be positive to the market. But do I really think there will be a cut in rate? That is something that I don't know how that will work, because again, if you're using the orthodox monetary policy tools, the inflation risk is still there. Because again, largely driven by stability in the exchange rate. We are just in a corridor of stability. We've not seen those stabilities. If you look at the report again, foreign direct investors are not really coming, and even foreign portfolio investors that are coming, when you look at the number that exit, also is almost commensurate to the numbers that come in.
Yeah.
So definitely that means there will be a huge risk in terms of the stability of the exchange rate. So that's why I'm not so thinking that there will be that cut in rate. But if that happens eventually, that definitely is a game changer. You shouldn't forget that, David, for past years, up to from the former management team of the CBN to the current management team, we've not seen rate cuts. So that would be something that has not happened for over 3 years.
And understanding that we have imported inflation largely in center stage, and we're still looking at the Federal Reserve as well now. Yeah. Just give me a number. What do you expect? I
just think rate will remain.
Okay. We'll leave the conversation here for now. Thank you so much for your time on the show today, Muktar. That was Muktar Mohammed, analyst at Assar Investments.